Good afternoon and good morning, everyone. Thanks for joining us today. My name is Ted Bader, president of SIA Wealth, and thanks for joining us on this hot July day to go over a few different things about what we're seeing here from SIA. We're going to talk about the major change in the portfolios, which is us moving to cash earlier in June. And then we're going to have Colin talk about what the charts are showing, and we're going to highlight what we're seeing currently, and then what trends we're going to see down over the next few months. So I'm going to get started right away, and I'm going to remind everyone at the end of the webinar, we do have a survey, and this survey is specifically going to highlight if there's any interest in a workshop that SIA has developed. So SIA Wealth has developed a tactical workshop. It's for advisors who are looking to, our tagline is make tactical practical. And it's about making asset allocation.
Ted, you've dropped out.
SI charting changes over client portfolios instead of using charts from a micro stock. So we've been running up through beta testing with a lot of success and a lot of great feedback. We're planning to launch this out in the fall. But if anyone wants to have a look at it beforehand and some of the tools that we've developed at SI Wealth through SI Charts, feel free to fill out the survey afterwards, and we'll reach out to you and set a time up for that. First off, I'm going to highlight first what's happened, and that is the portfolios that SI Wealth risk off indicator that happened on June 22nd, 2022. And we moved most of our portfolios over the next few days into cash or ultra short-term bonds, cash equivalents. That was because, you know, it's not something that was unique or surprising to anyone. We've seen market deteriorate from our point of view since last year, kind of mid to late 2021. And really, part of this question is what are we seeing in current markets? Now, I think we all need to understand that there's been a big paradigm shift. And whatever our assumptions were for the last 5 to 10 years and how we constructed our portfolios, I think most people would agree that the next 5 to 10 years are going to be significantly different. What the last 5 to 10 years was a bull market where it benefited buy and hold, more or less passive indexes as well. And it was exemplified by a low interest rate environment, low inflation environment, and very accommodative central banks. Going forward, those three things are the complete opposite. So we're going to have higher rates, higher inflation, and more restrictive central bank policy. So that means that the portfolios that were benefiting from the last 5 to 10 years might not benefit over the next 5 to 10 years. So a lot of advisors we're talking to are repositioning to include a tactical component to manage that type of risk going forward. And that's exactly where these the funds that we manage have kind of benefited from it. So now really is the time to be tactical. And I'm going to talk a bit about what that means. So as you can see here, we were raising cash as of March 2020, December and May of 2021 into March. And by the time we actually hit our red zone, we were 38% equity, and then we went to zero. So it was really a progression. And this comes from a few years ago. We were able to implement some more adaptable rules for SI Wealth to manage this risk. So even though we do use the equity action call as a foundation indicator, we do have the ability to raise some cash even while that equity action call is in the green zone. And likewise, if we start to see some opportunity while we're in the red zone, we do have the ability to allocate to specific equity asset classes in the red, through the yellow, into the green, whereas before we had to wait into the green zone. And we did have a lot of conversations with our advisors about that lag. So that's an important distinction that I just wanted to highlight to everyone. I'm going to talk specifically here, you know, what does this mean? We put an email out, and the fact is these funds have gone completely risk off. What we see is there's a lot of volatility in the markets. There's a lot of uncertainty. So you might have a few days where the markets rally back and then a few days where the markets give it all back. We've taken all of that risk off. And until we see a more dedicated long-term trend, we will stay out of the markets. So that's an important thing to know for you and your clients. We are looking at the charts every single day. And if we see certain asset classes such as commodities or anything else. Energy prices, for example, if they start to kind of climb back up and we see a dedicated trend, we will allocate to those equity positions in very considered and cautious approaches. So that's important. But again, us moving to cash this time was not as dramatic as it has been in the past. We used to go from 50 or 60% equity all the way to zero. In this situation, for some of the BMO funds that we run, we were already very, very heavily into cash. So as you can see, our global equity fund was already in 72% cash, and we just moved the remaining into the cash equivalents. Our asset allocation fund was 82% invested in fixed income and cash, and we moved that to 100% and all the way down the line. So this isn't a huge shock to most people. This was an expectation, and this was just a progression of the way we manage our funds going forward. So we just wanted to highlight where we were before and where we were after. And these calls of moving from 100% to zero almost overnight, or going from zero back into 100% cash, those don't happen anymore. We have a more gradual progression, and that's allowed us to kind of perform much better over the last year or 2 years than historically speaking. So a quick point. We do have a number of advisors who are reaching out to us and asking us and talking to us about, how do I incorporate a tactical sleeve? And a few things I'll highlight is, one, there are a group of advisors who already had a tactical sleeve and they've had it for the last few years. These conversations are the best because they've had numerous conversations with their existing clients to say, see, this is something that we're managing. So this risk situation that we've seen so far in 2022, it's something that those advisors have managed, and they have something to go talk to their clients about. Hey, Mr. and Mrs. Smith, I know you're a 60-40 portfolio, but we've automatically switched this from 60-40 to 40-60 because we've introduced a 20% tactical sleeve. So that's an existing situation where a lot of those clients and advisors have benefited, and they're actually starting to gain more assets and client referrals because they've been actively managing risk. The second part, where we've seen an incredible amount of inflows into our funds recently, is advisors who've been raising cash in their portfolios. As you know, these are classified as equity funds as most dealers. And a lot of advisors have already bumped up against their cash allocations for their investment policy statements. So a lot of advisors have started to include these funds in their portfolios as a way to kind of increase the cash allocation, take more equity risk off the table, yet still fit in the parameters that's created by their dealer side. So that's more of a short-term allocation, but it's something that's significant, and a lot of advisors have been able to do that for us. And then third, we have this question a lot, advisors who feel that the market is bottom. I'm going to go to what I briefly just said at the beginning, and it's based on your assumptions. If you assume that the Fed can stop raising rates, that they've got inflation under control, and if you think that the central banks can once again start to print off easy money, then yeah, we might have seen a market bottom. But I think most people look and say that there's risk and uncertainty in the system is significant. And even though we might have a short summer rally, I think there's a lot more risk going into the fall and into next year. And a lot of people are talking about a recession. So the whole point of that is it's never too late to include a tactical sleeve. If things start to rally and we start to get a sustained rally, like I just mentioned, we have the ability to start allocating to equities as we go from the red zone into the yellow zone into the green zone. And that should make a lot of advisors feel more comfortable allocating to a tactical sleeve. But the key thing is we've taken this risk off the table. So it's not about trying to generate excess returns. Right now, it's about capital preservation. And there's a lot of uncertainty in the market. So we've had a good conversation with that. I'm briefly going to highlight what we've seen from a fund point of view. So I'm hoping everyone can see our model here. This is Morningstar showing our BMO Tactical Global Equity Fund. As you can see, year to date, it is negative, but we have a negative 5% versus the market, which is negative 16%. And we're still third percentile year to date, which has been a very, very strong performer relative to the benchmark and relative to its category. This has allowed us to have a strong 3 and 5 year number where we're pretty close to first quartile across the board. But this is important for a number of situations because these funds are a great complement to existing portfolios. So when I look at this, I apologize. If I look at this from a risk perspective, this is exactly where you want to see a tactical sleeve perform, is very low risk here with above average return. So you can see here a risk return analysis. This is the category on the yellow. This is the index on the red, and we're much lower risk but a higher return. Look at this alpha here at 3%. We're beating the category at negative and the index, which is practically flat. And you get a very strong upside. So we're 73% versus the category, which has to outperform. So they get highly allocated, but our downside here at 57% versus almost over 100% for the category. So a lot of our peers need to be fully invested where we have the ability to pull that off. So this is our tactical global equity fund, which has been a big beneficiary of the recent inflows. And because we've taken the risk off. This is another one, our BMO focused North American fund. Again, similar, you can see here, year to date, we're negative 2% versus the index, which is negative 15. And we're second percentile here for year to date. That's allowed us to have a very strong 1 year and 3 year number. And this is exactly it. We're not going to be the strongest performers all the time, but if you look over an entire bull bear market risk cycle, this is exactly where a tactical sleeve needs to add value. And this is what we're trying to provide here for you and your clients. As you can see, again, from a risk-adjusted return, very much below average risk and above average return. You can see here clearly, this is really what the benefit of having a tactical component is. And I'm going to highlight the alpha again, 2.46 versus a negative alpha for the category and the index as well. So I just wanted to highlight a couple of these funds. Another fund, I'll quickly do it, is our Canadian focused fund as well. We've seen significant inflows in here. And again, this one year to date is the #1 fund in its category, in a quite a large category, which is Canadian equity. And it's been a very strong performer over the last year to date in 1 year. So the risk parameters, again, they do a great job of managing this risk with average risk and above average returns. So this is an important point to know. I know this is a bit of a product, showing you guys a bit of the product side, but it's important to know where we've seen at SIA Wealth the value of adding this tactical component and how the advisors are responding. So if there's any questions about that, feel free to reach out to me or anyone on the SIA Wealth team. But without much further ado, I know everyone wants to talk about the charts. So I'm going to pass it over to Colin right now, and I'm going to have him talk a bit about the charts and what we're seeing currently and how we can kind of manage the charts expectation going forward. So Colin, I'm going to pass it over to you. Let me know when you can see, when you have control of the screen.
Absolutely. Just give me 1 second, Ted, and I will be ready. Sorry, I just had to. I'm just updating my slides so we're on the right one.
Yep.
Here we go. And slideshow.
I can see it, Colin, so that's good.
There we go. Okay. Thank you very much, Ted, and thank you all very much for joining us on this beautiful day here in the middle of July. It's an interesting time of year for the markets. We've been on a seasonal basis. Markets often start the year off relatively strong, and then May and June historically have been fairly weak months for the market. We do often get a rebound in July that coincides with earnings season and kind of goes into the early part of August again, along with the summer earnings season. And then historically, the middle of August to the middle of October have been the weakest time of the year for stocks. And it's not uncommon for markets to see their 52-week lows for the year in October. I think back to years like 2002 or the summer sell-offs of 1998. And those 2 years I mentioned in particular because those were midterm election years. This likewise is a midterm election year. So, and it's not unusual to see volatility in the US and in world markets in and around in the months leading up to US midterm elections. This isn't unusual. What is unusual is, as Ted mentioned, is we're in a bit of a different environment now. We're in an environment of stagflation, which is high inflation and low economic growth. The goal, what everybody and central banks are really aiming for, is low inflation and high economic growth. And now we're in that opposite situation, and it's a problem. And particularly, central banks have found themselves far behind the curve on interest rates, and they're starting to catch up rapidly. Last week, the Bank of Canada raised our interest rate by a full 1%, which was more than the street was expecting. This morning, the European Central Bank raised interest rates for the first time in 11 years, literally since July of 2011. They've come off of zero, and doing it, they didn't do the quarter point increase everyone was expecting. They went half a point. So they're raising rates already more than people thought. And funny enough, I've seen chatter in the business press and elsewhere of, oh, well, the economy's slowing, the Fed will have to stop raising interest rates. Well, that's what we've kind of been trained to expect over the last 40 years, but we're no longer in the environment of the last 40 years. We're in the environment of the years before that, back in the 70s and the early 80s. And the reality is that there's very few people working in the business today that were in the business in 1980 to 1982. Those people that were there at the very beginnings of their careers, and they're getting ready to retire. Most of the people that were working in the business at that time have long retired. So it's a new era and a new world for a lot of us. And for a lot of us, that means changing. How do we look at things? What do we expect? What do we look for? And so we're seeing that as we move into earnings season as well. The other thing we have is markets had become fairly oversold, and we are seeing some bounces on with some earnings results being not as bad as people thought, but at the same time, a lot of them aren't that great either. You look at Tesla this morning, they beat on earnings, they missed on sales, their profit margin shrunk, and they're complaining about high costs. Other companies have been complaining about the high US dollar and rising cost margins getting squeezed. And so even if companies aren't necessarily doing as bad as people had feared in the short term, the environment is still really tough, and it's a difficult business environment, and it's an environment that may not necessarily be easy to get out of and could drag on for longer than people think. This isn't the COVID crash of 2020 where an external event happened, people reacted to it, and things got back going again. This is a lot of issues coming to the head at the same time. Anyways, that's my 2 cents on the current business environment. But I did want to show some charts to give us an idea of where we're going. And Ted talked a lot about the weakening of general indicators. And what we really saw over the last little while was a weakening of everything and an actual strengthening of cash. Cash has actually strengthened. The US dollar has strengthened. Investors have decisively gone defensive in recent months. We can see here, as an example, this is cash versus equities. And we can see that cash had spiked up briefly in 2020, then came down as the equity market recovered. In the early part of 21, this relationship kind of stabilized. And since the beginning of this year, it has shifted back in favor of cash. But this isn't the spike of 2020. This is the slow, steady increase. This isn't the on the equities falling. It's not the big plunge of 2020. It's slow and steady, consistent distribution, a longer-term trend of lower highs. But in this case, cash versus equities, an emerging trend of higher lows. Now we're looking at bonds. And bonds is important too, because one of the things we've seen this year is, again, a break in a 40-year trend. We had a 40-year trend of declining interest rates and declining inflation. And late last year, early this year, that all started to turn around. Central banks started to raise rates. They started to raise rates because they're way behind the curve on inflation. And even if things slow, at some point, they may not necessarily be able to turn on a dime and throw in stimulus the way they did 2 years ago, because they're so far behind on inflation, and they're still trying to deal with the impact of the last cycle, even as this one's actually starting to wind down. And so it's a problem. But one of the things was that people had, and Ted talked about long-term investment strategies. Well, one of the long-term strategies was the 60-40 balanced. That you'd have a certain amount of your portfolio in equities and a certain amount in fixed income. And historically, what was happening was, of course, when the economy turned down and stocks started to go down, well, central banks would cut interest rates and bonds would go up. Well, this time what we've had stocks going down and bonds going down, and quite sizable declines for both. The the 20% in first half decline for the S&P 500 and 10% plus declines for bonds, and two of the worst quarters for bonds in decades. And it's a real problem. We can see this here in cash as well, that we had to spike up in cash against bonds in 2020, and now we're seeing a more consistent increase this time. And we've broken out, and here we can see with this declining red lines, that we had a long-term downtrend in cash versus bonds that's now been broken. Cash has been outperforming bonds in a meaningful way this year, and we've seen in the media people starting to question, well, what about these balanced strategies, and what about other strategies? And yeah, we're actually moving into a new era, a new type of investing where perhaps these long-term strategies don't work as well as more tactical strategies, and that's something that is changing, and more people are starting to see that. Another comparison I brought up was stocks versus bonds, and so something else that I've been keeping an eye on as well is what's going on with stocks versus bonds themselves, because they're both going down. Well, we had 2020, 21, or at least 2020, off the market bottom was stocks outperformed everything, and then into last year, from March of 21 through pretty much the end of last year, they it peaked, and they just kind of started to go together. And then this year now, we've actually seen equities underperforming bonds. So as bad as bonds have done, equities have done worse. So it's still been a case, but cash has done better than both of them. So that's when we're thinking about when we're looking for these things. And it's also important because a lot of people are always asking us, well, when is the bottom? What is the bottom? What do we know when the bottom might come? And so perhaps historically, one of the things we've seen is that bonds have started to outperform stocks. Now, this is a bit early because in this case, both are going down. But at some point, if we do see the bond market bottom out, that could be an encouraging sign. But I also know that things have changed, so we're all kind of either going back to the 70s to see what happened or learning as we go. But certainly there's definitely some changes there. But this is intriguing. We are seeing that equities have actually been underperforming bonds, but there is also seems to be room for that to turn even more, because we're still way above trend. We're still way above anything that happened in 2020. It would be a long time before this long-term uptrend gets meaningfully reduced or erased in any sort of way. So here's the S&P 500, and we saw here that, of course, this was a very strong market from the March 2020 market bottom up until literally the first day of this year. The high close of this year was on January the 4th. And since then, we've seen this market come under distribution. We saw this strong moves, acceleration, a bit of leveling off right at the end of last year, and then the bottom started to fall out. And since then, we've seen a series of consistently lower lows and consistently lower highs. And we have seen a little bit of a rebound recently. This isn't unusual between it being earnings season or between it being seasonal, that we have had a little bit of a bounce here. We kind of bounced up into an area of previous resistance near where it had broken down before, in and around 3,200. We'll see what happens if it continues up from here or continues to encounter resistance. We'll see as we go. We have had a few good days here to start earnings season, even though it has been on mixed results. The question has it been a relief rally, or is this a sustainable turn? And it's too early to tell at this point in time. The TSX has had a pretty rough time the last little while. Interestingly enough, the TSX had been quite strong through most of last year, and even into this year, into March, April, the TSX had held up quite a bit better than the S&P 500. While the S&P was falling through the winter, the TSX was still showing signs of higher lows in accumulation, and that was from the benefits of the energy sector and the material sector, with commodity prices rallying. But since more recently, we've seen commodities start to turn down, and that has started to drag on the TSX. And we've seen this uptrend get broken, and it's kind of moved into an emerging downtrend here. And one of the reasons we've seen a bit of a pullback in Canadian equities, and I'll show two commodity charts here. First is crude oil. crude oil had this huge spike up where it ran from the 60s at the end of last year up to 120. It doubled, nearly doubled over the course of, let's call it 3 months. And the last spike up from 80 to 120 when the war in the Ukraine got started. Since March, the price of oil has basically leveled off and gone sideways, with support around in 90, 92, and resistance up around 120. We're still in that range. We have dropped back under 100 today, and in today's trading, and it is kind of back into this 90s range. But so far, the key support has been holding. If it does falter, then next support's kind of down around the low 70s and then around the low 60s. We're still keeping an eye on this. What's going on with crude oil right now? Well, on the one side, you have the political uncertainty and supply uncertainty related to the war in Ukraine and sanctions and how much oil could OPEC really produce if they were called upon it, and questions like that. And then on the other side, we have demand of if we go into a recession, that historically has curtailed demand. So for a long time, people have been worried about a shortfall of supply, and it's possible that could be shifting to the worries about a shortfall of demand. And that's, I think, why we're seeing that right now. Crude oil is stuck in this sideways range because that's kind of in balance, and nobody's sure yet which side may win out over the coming years. And this is one of the ones that really has impacted a lot of things, and that's copper. Copper, a lot of us look at because it has such a wide variety of applications. It's used in so many different places that demand for copper is considered to be kind of the closest market to what's happening in the global economy. People call it Dr. Copper, the metal with the PhD in economics, and it does give us an idea. So what is copper telling us? Well, it took off in 2020 and 2021, started to level off about the middle of last year, and had another run up in March. And since then, it's been rolling over. But most importantly, in May, copper meaningfully broke down. And this was about the time that the lockdowns in China started to really take hold. And the Atlanta Fed started cutting their US GDP forecast. And this concern that the world economy might really be going into another recession started to really take hold. And you could really see it in the copper price. So that's quite important, and that's one of the things that copper, through its impact then onto base metals, has been one of the things that's also been dragging on the TSX. I did want to highlight here as well the bonds. We talked about bonds, and I said, well, one of the signs if we do see the market of a market bottom might be if bonds start to bottom out in a meaningful way. And if we look at bonds so far, we can see that they really rolled down hard. In the early part of last year and again in the early part of this year. The big breakdown really has been this year. The bonds through TLT fell down to about their long-term trend line, which so far has held. And we have had a little bit of a bounce, but so far that's been just a 3-box reversal. That's what we consider to be a trading bounce. We haven't seen any change in pattern. It's still on the spread triple bottom signal. The SMAX at 4 is still bearish. So at this point, it looks like it's pausing, but it's hard to tell whether this is a pause forming a bottom, or a pause before another down leg, or a pause before a breakout. It's hard to say at this point. It's still too early. We're just monitoring bonds at this point in time. There's a little bit of encouragement, but not enough to really change anything meaningful yet in terms of trend. And the last thing I wanted to highlight here was the US dollar and the US dollar versus currencies. And this is really, really important because we're seeing that the US dollar index this year has exploded against everything. And the reason is because we've seen, with growing political uncertainty and growing economic uncertainty and growing financial uncertainty, a lot of capital has been leaving risk markets. A lot of capital has been leaving and flowing into US cash. We can't even say it's been US bonds or stocks. It's been US cash has been what's been outperforming. So one question I also get a lot is, well, what is wrong with gold? And why is gold not performing against the US dollar? And the answer is that gold actually is acting as a defensive haven. It's just that so much capital has gone into the US dollar that it's even swamped gold. But for most of this year, until the last couple of days, gold has been positive too. Again, in terms of price, gold has been holding up. It's only in the last 2 or 3 weeks that gold has really started to accelerate downward. The Canadian dollar, amazingly enough, with its sensitivity to gold and copper and crude oil, has actually held up reasonably well as well. Where we've seen the big declines have been in the euro and have been in the Japanese yen. The euro is down almost 15% this year and recently bounced off par. The Japanese yen, which historically had been a defensive haven, a place where people would go in times of trouble. If people were worried about, the Japanese yen's performance has been terrible. It's down 20% this year. The reason for that is, as we saw overnight, I talked about the central banks raising rates, except for the Bank of Japan. They've done nothing. They've kept their negative interest rates, and their currency has paid the price for that. So in reality, when we look at the currencies on more of a comparative basis, the US dollar is extremely strong. Gold has been holding up relatively well, as has the Canadian dollar, and it's things like the euro and the yen. And I didn't have room to put it on this chart, but then there's the whole story of cryptocurrencies and just how much they soared last year and they've been smashed this year as people left those kind of risk markets and returned to more defensive posturing. The other thing just to highlight as we move through earnings season is we have seen from a few companies starting to complain about the high US dollar, and that's something that also could be a drag on earnings, and advisors would be wise to keep an eye out. A higher US dollar tends to have a negative impact historically on US companies who export, US commodity related kind of companies, and US companies with large international operations. Anybody who exports gets a lower US dollar price, and or their goods become less competitive abroad. And the multinationals' problem is that the earnings of their overseas subsidiaries get translated back into US dollars at a lower rate, so they don't get as much. So you see, it's a high US dollar does put pressure on those companies. The companies that tend to benefit from a higher currency are importers, and then there's the more domestically focused companies where it's more neutral. So importers benefit, domestic focus is neutral, and exporters / multinationals, it's a negative impact. We saw IBM complaining about it. We've seen Tesla kind of complaining about it, and there could be others as well as we move through earnings season. If we don't see it this quarter, if the dollar holds up, we might see it more next quarter as well, as they've had more time to measure the impact of this. So that concludes my my remarks. I would be happy to turn the floor back to Ted at this time.
Thanks, Colin. I appreciate it. And we're going to wrap it up. I just wanted to remind everyone that there is a survey at the end. It's a very specific question. If you're interested in finding out more about this tactical portfolio workshop that we've developed, just say how interested you are to receive a call from us. The summertime is a great time to analyze your portfolio, figure out if you're positioned properly for the future, if you take anything that we said to heart. And it's a good time to kind of try to make your portfolio as tactical as possible. So feel free to reach out to that. And in the meantime, if you have any questions, reach out to anyone from SIA Wealth. And thanks. And FYI, we're not going to be doing a monthly commentary in August. There's a lot of vacations going on, so we're going to postpone that, and we'll see everyone again in September. Any questions, feel free to reach out to us. Thanks again, everyone, and have a great summer.